Hello and welcome to another episode of Market Brief After Hours. Today we are unpacking a session that can only be described as a geopolitical roller coaster. We started the day with genuine panic, saw heavy selling, and then witnessed a remarkable pivot as the dip buyers stepped in.
It really was a tale of two halves today. We had the initial shock from the escalating US-Israel conflict with Iran, which naturally sent everyone running for cover. But by the closing bell, the narrative shifted. It became a story of resilience, or perhaps just a very aggressive appetite for risk, specifically in large-cap tech and defense stocks.
It's fascinating how quickly the market digested that news. Let's look at the scoreboard, because if you just glanced at the closing numbers, you might miss the drama that happened intraday.
Exactly. If you look at the S&P 500, it actually managed to rebound and finish flat. It closed at 6882, edging up just 0.04%. But that number hides the fact that the index plunged as much as 1.2% earlier in the day. It was the energy and technology sectors that really hauled it back from the brink.
And the Dow Jones?
The Dow Jones Industrial Average showed similar resilience, but didn't quite make it back to green. It finished at 48,905, down 0.15%. That's a decline of about 73 points. However, keep in mind the blue chips were down nearly 600 points at the session lows, so trimming those losses was a significant feat as investors tried to calculate the long-term impact of the regional conflict.
And leading the charge on the recovery, as is often the case lately, was the Nasdaq.
That's right. The Nasdaq Composite ended the day at 22,749, gaining 0.36%. It clawed back from a deficit of 1.6%. This was really driven by strong performances in semiconductors and large-cap software. It seems when uncertainty hits, the market still treats big tech as a safety blanket.
While the U.S. managed a recovery, the story was quite different across the Atlantic. It seems European markets didn't have that same late-day cushion.
No, they didn't. Europe closed sharply lower. The risk-off mood was broad. The pan-European Stoxx 600 fell nearly 1.7%. If we look at specific countries, Germany's DAX dropped about 2.6% to 24,672. That is its lowest level since early February.
That is a steep drop, especially considering there was some economic data out of Germany that looked decent.
That's the irony. Germany's manufacturing PMI actually rose to 50.9, which is the first expansion since June 2022. But the geopolitical fear completely overshadowed the economic data. France's CAC 40 slid 2.14% to 8,397, and Italy's FTSE MIB fell 2% to 46,280. The UK's FTSE 100 also lost 1.26%.
And speaking of the UK, energy prices there went parabolic.
They did. UK natural gas futures surged more than 20% toward 100 pence per therm. That's purely driven by fears of LNG supply disruptions. It's a direct consequence of the tension in the Middle East.
Let's briefly touch on Asia before we take a break. It seemed like a mixed bag, but mostly red.
Mostly lower, yes. The airline sector took a beating due to airspace disruptions and rising fuel costs. We saw Singapore Airlines, ANA, and JAL each falling more than 5%. Japan's Nikkei 225 fell 1.35%, and Hong Kong's Hang Seng dropped 2.14%. However, mainland China bucked the trend slightly, with the CSI 300 rising 0.38%.
It seems the airline slump makes sense given the oil prices, which we will get to in a moment. But first, let's take a quick break. We'll be right back to discuss the technical damage in the Forex markets and the massive moves in commodities. Welcome back to Market Brief After Hours. Before the break, we talked about the equity markets, but the currency markets were moving just as fast, and technical levels were being tested left and right. Let's start with the euro against the dollar.
The euro-USD pair took a hit, closing at 1.1691, down 1.02%. The technical damage here is notable. The heavy selling pressure dragged the pair below its key short and medium-term averages. Specifically, the price pushed beneath the 100-day simple moving average at 1.1695 and is now firmly below the 50-day SMA at 1.1763.
So it's lost that bullish momentum from earlier in the year?
It certainly looks that way. It's carving out lower highs and lower lows. It is still holding above the 200-day SMA at 1.1636, but barely. That 100-day line has now turned into immediate resistance. If we see a clear break below that 200-day average, the broader bullish structure is in real trouble.
What about the British pound?
A similar story of drifting lower. GBP USD ended at 1.3403, down 0.62%. The pair slipped below the 200-day SMA at 1.3447. It's currently capped by the 50-day SMA way up at 1.3592. Crucially, it's hovering just above the 100-day SMA at 1.3397.
That sounds like a very tight spot.
It is. The 100-day SMA is acting as a critical inflection point. A decisive close below 1.3397 exposes the recent lows. The inability to reclaim the 200-day average keeps the near-term bias tilted to the downside.
Now, shifting to the yen, we saw a different move. The dollar seems to be tearing higher against the yen.
Absolutely. USD JPY advanced to 157.34, up 0.85%. This is a strong bullish session. The pair is trading well above all major moving averages. You have the 50-day SMA at 156.02, the 100-day at 155.16, and the 200-day way down at 150.36.
So we are in uncharted territory there?
Pretty much. Momentum is firmly with the buyers. There is limited technical resistance beyond the session high. As long as it holds above the 155.94 support zone, the bullish structure is intact.
And finally for currencies, the Swiss franc. Usually a safe haven, but the chart looks messy.
It was a volatile one. USD CHF rebounded sharply to close at 0.7796, up 1.48%. It formed a bullish engulfing candle, which usually signals a reversal. However, structurally, it's still weak. The price remains below the 50-day SMA at 0.7824, the 100-day at 0.7914, and the 200-day at 0.7977. All those averages are sloping lower, so the medium-term trend is still bearish despite today's pop.
Let's move to the catalyst for much of this volatility, oil. The numbers were staggering today.
Staggering is the right word. We had reports that Iran's Revolutionary Guard had closed the Strait of Hormuz. That sent U.S. crude jumping 8.4% to $72.74 per barrel. Brent rose 9% to $79.45. At one point in the session, gains were over 12%.
And this isn't just about gas prices. This reignites the inflation fear, doesn't it?
That's the big worry. A prolonged disruption to global energy flows feeds directly into pricing pressures. You saw this reflected in the bond market. U.S. Treasury yields moved higher despite the geopolitical tension. Usually, investors buy bonds for safety, which lowers yields. But today, they sold bonds because of inflation fears. The 10-year yield rose 8 basis points to 4.044%.
So if bonds weren't the safe haven, was gold?
Gold did its job. It closed at $5,335, up 1.08%. It continues to trade well above its 50-day SMA at $4,796, its 100-day at $4,459, and the 200-day at $3,947. The uptrend is very strong. We are within striking distance of the all-time high near $5,560.
Silver, however, didn't have as good a day.
No, silver suffered a sharp pullback, falling 3.99% to close at $90.02. It actually hit a high of $96.40 before reversing. It looks like profit-taking after a failed breakout. However, it's still above its 50-day SMA at $83.94, so the broader bullish structure survives, but near-term momentum has definitely cooled.
Let's talk about the digital gold. Bitcoin had a significant session as well.
It did. Bitcoin rallied towards psychological resistance, ending at approximately $68,938. That's a 4.4% gain. It briefly touched the $70,000 mark. It's tracking the recovery in broader risk assets like the Nasdaq.
And that $70,000 level is the line in the sand?
It is the immediate resistance. A failure to hold the $65,000 level on a retest could signal a short-term top. But right now, the breakout suggests a resumption of the bull trend.
This rally in Bitcoin naturally brings us to our market movers segment. We saw some specific stocks jump on the back of this crypto move.
Yes, Strategy, the Bitcoin Treasury company, gained about 6%, and Coinbase climbed roughly 6% as well. When Bitcoin pushes $70,000, sentiment across all crypto-linked equities lifts.
And looking at the S&P 500, the strongest performer was Palantir.
Palantir surged 6%. This ties back to the geopolitical theme. Investors are expecting rising government demand. U.S. government revenue already accounts for 41% of their sales,
And with stepped-up defense spending likely due to the conflict, Palantir is seen as a primary beneficiary.
We also saw energy stocks moving, obviously.
You can't have oil up 8% without energy stocks moving. ExxonMobil and Chevron gained about 1%, but ConocoPhillips climbed more than 4%. Investors are pricing in sustained strength in oil markets.
It wasn't all green, though. Berkshire Hathaway took a hit.
They did. Class B shares fell nearly 5%. They reported a sharp decline in fourth-quarter operating earnings. It seems weakness in the insurance segment weighed heavily on the results, overshadowing the rest of the portfolio.
And finally, a massive drop for AES.
AES plunged nearly 18%. This was due to a takeover agreement. A consortium agreed to acquire them for about $11 billion, which translates to $15 per share. The market adjusted the price immediately to reflect that deal valuation.
It's rare to see a stock drop on a buyout, but it depends on where it was trading before.
Exactly.
So to wrap up, we have a market that is willing to buy the dip, but is also staring down the barrel of inflation caused by an oil shock.
That's the summary. The session showed resilience, but the confidence is conditional. It's balancing short-term shock against long-term bullish trends. But the surging oil prices and rising Treasury yields are the real signals to watch. Until we have clarity on the duration of this conflict, we are going to see sentiment swing very quickly between relief rallies and risk aversion.
A fragile balance indeed. We will be here to track it all. If you find this useful, please follow Market Brief After Hours on your preferred platform. Thanks for listening, and we'll catch you at the next close.